$121 per ounce. January 29th, 2026, silver printed an all-time nominal high, a price no human being alive had ever seen in the entire recorded history of the metal. Within 30 hours, it was gone. Silver collapsed 33% from $121 to $76 in less than 48 hours. The single largest intraday price collapse in precious metals history since the Hunt brothers episode in 1980. The headlines called it a crash. The media called it a bubble bursting. But while the paper price was collapsing, something else was happening at COMEX warehouses. 74.38 million ounces of physical silver demanded and delivered in just 60 days. That's 86% of current registered inventory, moved in 2 months. JP Morgan raised their 2026 silver forecast from $56 to $81 per ounce, a 44% upward revision. That's more than double silver's 2025 average. And right now, March 9th, 2026, silver sits at 84, trading almost exactly at JP Morgan's full-year average target. Hi, I'm Roxanne. Let me show you what the paper crash hides and what the physical delivery data reveals. January 2026 started with silver at $70 per ounce, extraordinary on its own. Silver had surged 130% through 2025. Then the rally accelerated. By January 26th, silver broke records. By January 29th, it hit $121. The gold to silver ratio briefly fell below 50, a level not seen since 2012, a level that has occurred on fewer than 6% of all trading days since 1985. From April 2025 to its January 2026 peak, silver gained 147%. Gold, which everyone was watching, gold crossing $5,000 and making headlines daily, gained 67% in that same period. Silver outran gold by more than double. Then came January 30th. Friday morning, President Trump announced his intention to nominate Kevin Warsh as the next Federal Reserve Chair, a candidate markets perceived as significantly more hawkish than expected. The dollar spiked. DXY surged. Within 28 minutes, silver fell 11%. Gold dropped $380, nearly 7% in the same time frame. By end of day, January 30th, silver had collapsed from $121 to $78, a 31% single session decline. Month-end positioning exacerbated the move. January 30th was the final trading day of the month. February 1st fell on a Saturday. Markets wouldn't reopen until Sunday evening. Traders facing margin calls had no ability to adjust positions over the weekend. The crash wasn't just price action, it was forced liquidation. CME had moved to a percentage-based margin system on January 13th. Maintenance margins jumped to 15% for standard positions, up to 16.5% for heightened risk. The exchange effectively ended the era of cheap paper speculation that allowed traders to control 5,000-ounce contracts with minimal collateral. When silver started falling, margin calls cascaded. Leveraged positions unwound violently. By February 5th, silver briefly touched 65, down 46% from the January 29th high. The media declared the bubble burst. Analysts called it a speculative blow-off. The narrative was simple. Silver went parabolic, leverage imploded, rally over. But that narrative misses what happened underneath the crash. Because while paper silver was collapsing 33% in one session, physical silver in Shanghai was trading at $120 per ounce, a premium of up to 54% over Western paper prices. In India and Asian hubs, physical premiums hit $8 per ounce. A two-price world emerged where paper no longer reflected physical reality. In the aftermath of the crash, JP Morgan did something remarkable. They raised their 2026 silver forecast from $56 per ounce to $81 per ounce. That's a 44% upward revision, one of the largest forecast increases JP Morgan Commodities Research has ever published for any metal. Their quarterly 2026 forecasts range from $75 to $85 per ounce, with Q4 2026 projected at $85. For 2027, they forecast an average of $85 per ounce. Why would JP Morgan dramatically increase their forecast immediately after the largest crash in 46 years? Because they're not looking at the paper price. They're looking at structural supply-demand fundamentals. Gregory Shearer, head of base and precious metal strategy at JP Morgan, laid out the thesis. Silver underwent a nearly 130% increase in value in 2025, starting the year at 29 Oz and rising to over $70 Oz by year's end. Part of that increase came from U.S. tariff policy uncertainty around critical minerals under Section 232 review. Silver was added to the U.S. critical minerals list in late 2025, recognizing its indispensable role in green energy and advanced electronics. That designation changed procurement priorities for government-backed projects and strategic reserve calculations. But here's what JP Morgan emphasizes. The $81 average isn't a bullish fantasy. It's their base case scenario, assuming current supply-demand dynamics persist. They're also clear about the risks. Long term, the largest risk we see for silver comes from more widespread adoption of silver-free technology, such as cadmium telluride thin-film solar, Shearer noted. About 60% of silver demand, excluding ETF flows, comes from industrial applications. Solar panel manufacturing is the largest single industrial use. High silver prices have already set in motion a meaningful acceleration in substitution and thrifting trends, manufacturers reducing silver content per panel or switching to alternatives entirely. If solar thrifting accelerates faster than expected, industrial demand contracts. That's the bear case. But JP Morgan remains structurally constructive on silver because of a critical supply constraint. Silver is predominantly mined as a byproduct of other metals. Over 70% of silver comes from gold, lead, zinc, and copper mining. You can't just turn on silver production when prices rise. The geology doesn't work that way. Supply is constrained. Demand, even with solar thrifting, remains elevated, and the structural deficit continues. The Silver Institute confirmed in its February 10, 2026 annual outlook, relying on analysis from Metals Focus, that the silver market is heading for its sixth consecutive year of structural deficit in 2026. Not 1 year, not two, 6 consecutive years. Every single year since 2021, the world has consumed more silver than it has produced. The cumulative deficit across 2021-2025, approximately 820 million ounces. That's not a rounding error. That's a mountain of metal that was supposed to exist but doesn't, which brings us directly to COMEX. While silver was crashing 33% on paper, something extraordinary was happening at COMEX warehouses. January 2026, 49.2 million ounces delivered. That's 10 times the delivery volume recorded in January 2024. Not 10% higher, 10 times. February 2026, 25.18 million ounces delivered. That's 8 times the historical norms for February, typically the lightest delivery month of the year. Add them together. 74.3 million ounces demanded and delivered in 60 days. Now here's why that number is staggering. As of March 6, 2026, total COMEX registered silver inventory, the silver actually vaulted, certified, and available for physical delivery, stands at 81.2 million ounces. In 60 days, COMEX delivered metal equivalent to 86.4% of its current entire registered inventory. 86.4% of what currently sits in those vaults walked out the door between January 1st and end of February. And that's not counting March. March opened with 10,526 contracts standing for physical delivery, representing 52.63 million ounces against registered inventory of 86.13 million ounces on first notice day. One contract month demanding 61% of available inventory. This isn't speculative positioning. This is physical procurement. Managed money positions, the speculative traders, fell from 54,415 contracts in February 2025 to just 12,121 contracts in February 2026. That's a 77.7% year-over-year decline. The speculators left. The physical buyers stayed. Who's taking delivery? Industrial users, institutional investors, companies that need silver for solar panels, electric vehicles, semiconductor packaging, AI infrastructure, they're not waiting for pullbacks. They're securing supply immediately because they know the inventory numbers. On February 11th, 2026, a single trading day, COMEX registered inventory dropped by 3.56 million ounces in one adjustment. One day. 3.25 million ounces walked out. That's not a data anomaly. That's behavior. That's buyers deciding the metal belongs in their hands, not on an exchange ledger. The cumulative deficit since 2021 is approximately 820 million ounces. COMEX registered inventory declined from 240 million ounces in April 2020 to 81.2 million ounces as of March 6, 2026, a 64% drawdown in 6 years. Shanghai Gold Exchange silver inventory hit 10.24 million ounces in early February 2026, its lowest level since 2015. Combined, COMEX and Shanghai drawdowns account for roughly 161 million ounces over 6 years. That represents approximately 19.6% of the 820 million ounce cumulative deficit. Where did the remaining 659 million ounces go? Irreversible industrial consumption, solar panels, electronics, EVs, medical devices, AI infrastructure, semiconductor packaging. That metal is gone, embedded in rooftops, circuit boards, battery packs across 6 continents. It cannot return to market without prices significantly higher than current levels because the economics of industrial silver recovery aren't viable below a threshold the market hasn't cleared. Silver in a solar panel has a recovery rate measured in decades, not months. Silver in a semiconductor is effectively permanent consumption. The Silver Institute's language is precise. Physical liquidity in the London silver market may remain relatively tight throughout 2026, and the market will continue to rely on drawdowns from above-ground inventories to close the demand gap. Industrial fabrication is forecast to decline 2% in 2026 to around 650 million ounces, driven by solar thrifting and substitution. But physical investment demand is forecast to surge 20% to a 3-year high of 227 million ounces. After 3 consecutive years of decline, Western retail investment is expected to rebound sharply. Global ETP holdings currently stand at 1.31 billion ounces, just 7% below all-time peak. The physical investment side isn't slowing, it's accelerating. Here's the paradox JP Morgan's $81 forecast tries to reconcile. Paper silver crashed 33% in one session. Physical silver keeps draining from exchanges at record pace. Both cannot be telling the same story. The great divorce of 2026, as some analysts call it, is the divergence between paper contracts and physical metal. COMEX open interest represented approximately 1.586 billion ounces in early 2026. Registered inventory, 108 million ounces at the time. That's a leverage ratio of about 14 to 1. 14 ounces of paper claims for every ounce of deliverable metal. If just 7% of futures holders stand for delivery, COMEX vaults empty entirely. CME's margin hikes in January weren't random. They were designed to prevent exactly that scenario, a clearinghouse collapse as prices surged toward $120. The exchange effectively busted the paper leverage structure the same way regulators ended the Hunt brothers' silver position in 1980 by raising margin requirements and forcing liquidation. But here's what the margin hikes don't solve: the physical deficit. You can raise margins. You can force speculators out. You can crash the paper price 33% in 30 hours, but you can't create new silver. You can't refill the vaults. You can't reverse the structural deficit. And that's why JP Morgan's $81 forecast matters. It's not a prediction that silver runs to $120 again tomorrow. It's an acknowledgement that even after the crash, even after speculators got washed out, even after the leverage unwind, the base case for 2026 is $81. Right now, silver trades at 84.37, almost exactly at JP Morgan's full-year average. The gold to silver ratio currently sits around 60. On March 2nd, with gold at $5,087 and silver at $93.25, the ratio printed 57.77, the tightest since those brief January days when it fell below 50. The ratio compressed from 105 in April 2025 to where it is now. That compression alone represents the most dramatic repricing of silver relative to gold in modern market history. Bank of America's Michael Widmer published scenarios ranging from $135 to $309 per ounce for silver, not as base cases, but as ratio compression scenarios grounded in historical precedent. The $135 scenario maps to the 2011 gold to silver ratio low of 32.1. The $309 scenario maps to the 1980 Hunt Brothers ratio of 14.1. These aren't fabricated numbers. They're what silver would need to be at today's gold price if the ratio compressed to those historically observed levels. $121 on January 29th, 76 on January 30th, a 33% crash in 30 hours, 74 million ounces delivered in 60 days, 86.4% of registered inventory moved in 2 months. JP Morgan raised their forecast 44% from $56 to $81 immediately after the largest crash in 46 years. Silver now trades at 84.37, almost exactly at their full year average target, the sixth consecutive deficit year. 820 million ounces cumulative shortfall since 2021, 659 million ounces absorbed by irreversible industrial consumption. The paper market says crash, volatility, speculation unwound. The physical market says draining vaults, record deliveries, institutional procurement. 4 things to watch going forward. First, COMEX registered inventory. If it continues draining at current pace, 22 million ounces over the past 30 days, we're looking at approximately 80 trading days until registered stocks approach zero at current withdrawal rates. Second, the gold to silver ratio. If it compresses back toward 50, silver reprices violently higher. If it widens back toward 70-80, the paper market reasserts control. Third, solar thrifting pace. If manufacturers accelerate silver reduction faster than expected, industrial demand contracts and JP Morgan's $81 becomes the ceiling, not the floor. Fourth, whether speculative positioning returns. Managed money is down 77% year over year. If Western retail comes back, if the SPDR Silver Trust premium shifts from 6% discount to 10-15% premium, that spread alone multiplies returns beyond the physical price move. The logical projection isn't that silver runs to $309 tomorrow. JP Morgan's $81 implies we may spend significant time below current levels if macro stabilizes. But the question remains, how long can an 81 million ounce vault satisfy demand that drained 74 million ounces in 60 days? What happens when the buffer between paper price and physical reality disappears isn't a question with a guaranteed answer, but it's the question you should carry into every conversation about silver going forward. Verify the delivery data at CME Group. Check the Silver Institute's deficit projections. Review JP Morgan's commodities research. All sources are public and updated regularly. This is educational analysis based on documented delivery data and institutional forecasts, not financial advice. The vault is emptying. The deficit is cumulative. The paper crashed. The physical keeps moving. And we're 60 days into a pattern with no modern precedent.